Welcome to Stock Watch. I'm Zinati Kuma, and joining me to unpack your stock-related questions this evening are Pierre Verster from Protea Capital Management and Roy Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X at BusinessDayTV using the hashtag StockWatch. Thanks, gents. Of course, everybody was in a panic yesterday, but seeming that not really today. But I mean, even that rebound that we're seeing in the US and European markets doesn't really make up for what we lost yesterday. I want to start off with you, Roy. There's an interesting question here. Robert Kiyosaki, the rich dad, poor dad guy, has predicted a big stock market crash in February. What's your take on this? Does it look like he was a bit of a clairvoyant there, Roy?
Hi, Zinati. Look, it's interesting, and all the talking heads will come out here and say doomsday, and we told you so, the market was overvalued. But I think there's something to be said about that correction yesterday. I think, first of all, the market's become very concentrated. And anything that impacts those huge stocks will impact the stock market in aggregate.
Okay.
But when you look at the equally weighted indices, they actually didn't do badly. They didn't fall as much. So what you had was a few really big stocks, particularly Nvidia, losing a hell of a lot of market cap. And actually on the other side, the consumer staples and discretionary, you actually saw share prices go up. So it's effectively a rotation. And all the market has done is it's recalibrated its view on earnings expectations and just how strong the moats around these businesses are. It's not an aggregate stock market correction. The VIX didn't blow out significantly. And like you're saying today, you're seeing a little bit of a recovery.
Well, let's zoom in on Nvidia because, of course, Roy talks about this concentration, and Nvidia really is a very big part of that. Some people have said that yesterday was an overreaction. Some people are saying DeepSeek is actually going to structurally change the market. What's your view there, JP? Was it an overreaction? Do you think that this was a valid response from the market yesterday?
Yes, interesting one. So I think firstly, the expectations that were discounted in the Nvidia share price before yesterday were very bullish, were very optimistic, high expectations. And when high expectations meet disappointment, or when high expectations meet disruption, you normally have a significant share price move. And that is what we saw. So you've mentioned the two, call it dominant narratives, the two scenarios that could play out. The one is very negative for Nvidia. A lot of the big, what you call hyperscalers, Microsoft, Alphabet, Meta, Amazon, would buy less of their chips because they would need less of their chips because DeepSeek has shown a more effective way to train large language models and to run the inference, actually use the large language models. But there is a scenario that says, well, maybe they'll use the same amount of chips. They'll just now make these large language models even more powerful. They'll give them more data and they'll train them even quicker. So that's what the market is grappling with. My view is it'll probably be somewhere in the middle. I don't think it was a positive for Nvidia. It might be a positive for some companies that use these chips because they might use a bit less of them and that will save them some money. But it probably is not as negative as losing $600 billion of market cap might imply.
Yeah, that was a lot. That was hectic. Well, on that, there is a specific question. Your views on Nvidia as a long-term buy after the launch of DeepSeek and its effect on the market recently. We did have actually someone, I think about an hour ago, picking Nvidia as her stock pick, Roy.
So the thing about Nvidia and what's really driven it was the fact that they were at the cutting, bleeding edge of producing these chips. And the competitive advantage they had was that they were the only ones who could produce this, and they were the only ones who were improving on each of them. And the entire ecosystem around them was dependent on them producing these new chips. When you looked around, there was no one following on them. There was nobody chasing after them. So it looked like they had a deep moat big barriers to entry, and the innovation was purely about them. What DeepSeek does, and why you saw such a violent reaction yesterday, was to say, maybe you don't need that much capex. Maybe you don't actually need such cutting edge chips. And the fact that now it is open sourced, that people have direct access and they can program their own stuff on it, just means that your moat is gone. Effectively, when people were paying for open AI and all of that, they were opening for access to very proprietary stuff. And that was leading edge. Now it looks like your costs of switching are probably going to be much, much lower. And that reduces your competitive advantage as Nvidia. So is it that $1 trillion, whatever market cap it had before yesterday? Clearly not. Is it worth nothing? Clearly not. It's somewhere in between. And I think over the next few months, we're going to see the market trying to arbitrate with where the value is. But I think the one conclusion we have very clearly here is that that moat is gone. That's the one thing that we have very clear.
All right. Well, Jen, sticking with another theme from the US, of course, we know that there's a lot of noise and policy moves happening around oil. There is a question on an ETF here. I don't think it's what we would say in Afrikaans, van ek. I think it's more van ek. What are the panel's views on the following ETF as long-term buy? So 10 years plus, the van ek oil services ETF. And actually quite interesting that it is oil services, because a lot of people have been saying that they're looking to oil services companies that would support the oil producing companies that will be drilling the oil from the ground. JP.
Yes, I would probably need to have a look to see what the constituents are of that Van Eck ETF. So I'm guessing it'll be SLB and a few of the other either companies that drill or are involved in the extraction of oil, but more putting in the infrastructure so the oil company can get the oil out of the ground rather than the oil company itself. If that is the case, which I think is a fair assumption, then it's an interesting idea. It means that one thinks that the US are going to drill a lot more.
Yeah.
Whether it's onshore or whether it's off the coast, deep water drilling, that will lead to more business for these oil services companies. A Republican government, especially a Trump-led one, is normally good for deregulation and is normally good for more drilling of holes in the ground. That's why they say drill, baby, drill when it comes to the Republicans. So yes, that could be good for the oil services. I would say that still, it also means that if they get more oil out of the ground or out of the sea, it implies that the world needs more oil. And that's a more difficult question because we've had a lot of shifting away from carbon-based energy, from oil and coal to other more renewable energy sources. I think people are realizing that maybe that shift happened a bit too quickly. We still need oil and even coal for maybe a bit longer. But if we are going to have a lot more oil, and if these oil service companies are going to be a lot more busy, then you want the world to use more oil. And at the moment, economic growth is strong. I wonder how strong it's going to be over the long term. So I wouldn't put all my money in this ETF, but a little allocation could be interesting for the scenario that the world actually uses more oil and therefore companies drill for more oil.
Roy, is it lights out on the other side of the coin? Is it lights out now for renewable energy companies, particularly in the US?
Well, clearly in the US, it looks like over the duration of the Trump administration is going to be incredibly difficult for them. That's that without a doubt. But I mean, I think there is a place for renewable energy. There's a place for renewable energy within the energy mix. And it's very important to not be exposed entirely to one source. And I think that's where the world is coming to understand that there's a place for solar, there's a place for coal, there's a place for oil, there's a place for gas. And as a portfolio, you can minimize your cost, minimize your risk, and increase your access to multiple energy sources. So it's going to be difficult in the US. It's going to be difficult in the rest of the world, I guess, if you want to have a relationship with the US. But no, I don't think it's the end of the road.
Yeah. I remember there was an ETF that came out, was it 2 years ago, that said, go woke, go broke. I wonder how it's doing. There is a question I want to ask here, which seems, I don't know if the word is dodgy. Please, can you explain why the Satrix S&P 500 goes the opposite direction of the US S&P 500? JP?
So I think when you look at what happened yesterday, you need to keep in mind that the S&P 500 is denominated in US dollars, and the Satrix feeder fund is denominated in rands. So even though the US market fell quite sharply yesterday, at the same time, the rand weakened, which is good from a South African investor's perspective. So that's why you did not see the big drop in the Satrix S&P feeder, because the weakness of the rand offset the drop in the S&P 500 in dollar terms.
All right. Well, gents, let us go into insurance. There's a question on Sanlam and there's a question on Old Mutual. So naturally, I'm going to give Old Mutual to Roy. Why does Old Mutual stay in the doldrums? And I see here, I don't think we have the charts up yet, but I see that it's been on a downward trend in the short term, I guess, since December, but also really having reached some sort of high in September, and it's just really been, it hasn't been looking good. Roy, Old Mutual?
Yeah, so Old Mutual, I suppose the life insurance companies are interesting from the perspective that they effectively bond proxies, or rather they carry large portfolios of bonds to fulfill their obligations in the future. Old Mutual has a big reliance on policies to the retail market as well. And as you can well imagine, I think things have been quite difficult for that segment of the market. So they haven't seen much in terms of top line growth. And then in addition, I think more recently, when bond yields got to their absolute low, the share price had a little bit of a trot, but it stalled just in line with that. So I don't think there's any difficult message that the share price is trying to tell you. It's just that the market is quite tough. Their products are more sold than bought, and bond yields are probably as low as they're going to get domestically.
Yeah, I mean, would some of what Roy said apply to Sanlam as well? Because the same question for Sanlam as well. The share price has been dropping over the last weeks, and Sanlam has actually been doing well when you look at their numbers, JP.
Yes, they've also been very busy on the M&A front. There's been a lot of deals. So, you know, they had Absa Asset Management that they merged with Sanlam Asset Management, and now they announced a deal late last year that they're going to sell that and merge it with 91's active asset management division. They did a deal with Allianz across the rest of Africa. They sold the Capitec business, but then bought Assupol. So there's been a lot of corporate action when it comes to Sanlam. And I think just about all those deals have been very shrewd deals, very good deals done by the management team, the executive office at Sanlam. But it does mean that it's a bit of a different animal today than what it was, say, 2 years ago. You can look at the embedded value per share as an indication of what fair value could be, because they're always very conservative in their assumptions. With the new IFRS accounting standards, though, most of the insurers are going to move away from embedded value, so that makes it a little bit more tricky to work out what fair value would be according to the actuaries of the share. But now we can use, call it more price earnings ratios and traditional ratios that you would use for other companies when it comes to life insurers. So putting that all together, I think that Sanlam maybe got a little bit expensive late last year. It's trading closer to fair value at the moment. But in terms of quality and how conservative the actuaries are with their assumptions, I would say it's probably still my preferred life insurer in the South African space.
Yeah, all right. We'll talk about preference. I think I did ask you the other day if you prefer City Lodge or Sun International. I think you said you were bullish on both, JP. So there is a question on both. So I'll give that to Roy because I do have a very specific question for you, JP. So Roy, should I hold on to City Lodge or sell and take a loss? I paid about R4.50 a share. I think now it's at R4.30. And should I buy Sun International? So they're asking if they should sell City Lodge and buy Sun International, Roy?
So I'm not sure about the buy-sell decision, but I'll tell him what he's investing in. So when in City Lodge specializes in the business traveler, mostly in Gauteng, and occupancies based on people coming in to do business here, that hasn't quite picked up. Sun International, on the other hand, is benefiting from the Western Cape and the coastal regions, and that's where occupancies are quite high. And remember, for both of them, the advantage is that there's not much more construction on the go for new hotels. So for Sun International, as occupancies start reaching high levels, you get some pricing power. And for so long as the Western Cape summertime is booming as much as it's had in the last couple of years, you will see growth in earnings. It's going to take a little bit more of an effort for City Lodge in Gauteng. Although, remember, there's the G20 in the next 12 months. There probably would be a little bit more activity around here, and you could see some of their occupancies rising. These are long-term investments. I would strongly advise the investor to be patient, give the management team and the environment an opportunity to see their efforts come to fruition. Neither of these businesses, City Lodge is not going bankrupt. They did their rights issue, they fixed themselves up. Now it's a matter of executing and the environment working out for them. So I guess that's a long way of saying that it's a reasonably run business at a particularly tough period of time, but I think the dawn is coming for them over the medium term.
I mean, the tourism numbers are going. We did have Stats SA releasing some numbers out today. But also there was that, I think, a UN report that came out that said that global tourism is back to pre-COVID levels, but South Africa is still not back. So I also spoke to, the CEO of the Tourism Council SA today, and he said that we just need to do more. So you're right. It does require some patience. JP, what is Mercadolibre, if I'm even saying it right? And do you hold it in your funds?
So, Zenati, you need to say it with the Spanish accent. Okay. Mercadolibre.
All right, okay.
Yes. It's a South American e-commerce and fintech business. So, in very broad terms, you can almost say it's like the takealot.com of South America, with a little bit of fintech thrown in as well. Yes, we do hold it. I like the company. I think they are doing good things and building a moat and becoming the dominant platform for e-commerce in South America. So yes, I like Mercadolibre quite a lot.
Okay, thank you for teaching me something new today. There's a question here on Anglo American. I'm not getting the thing right now, the email, but I think from what I can remember, just asked your view on Anglo American after BHP basically came out and said that they're kind of putting that on ice for a while.
Well, clearly there's been a bit of a bid premium on the share price, and you've seen the share price come off since that announcement. But I think Duncan Wablat, the CEO, continues with his plan. Sell down on Anglo Plats, clean up on some of the peripheral assets, effectively dress up the business either to continue running and be the aggressor or be part of another merger somewhere. Remember, they've got some very interesting assets. They've got the copper assets, they've got iron ore, and as a business, they can see clearly where they're going. So maybe it will take a little bit longer to realize value from there, but clearly the first steps have been made. There's a very distinct strategy. There's an understanding as to why they've underperformed historically and a clear direction that they're going under. So I think there's probably value there. The share price movement over the short term would be influenced by bid premiums, but nothing really wrong with them apart from the cycle, I guess.
Yeah, it's quite interesting because after it came out that Glencore and Rio Tinto may be in talks, that maybe this could accelerate BHP's bid for Anglo, but actually they went the opposite. JP, is this also just signaling that BHP is fine? They'll be fine without Anglo American's assets, and particularly those copper assets.
Yes, and I think there's increasing concern about diamonds. So maybe they had a plan what they would do with the diamond exposure. Now maybe they think, maybe that's not a great asset to own, or they were thinking about the issue of Kumba. They might have had a plan also because they don't really want more iron ore. They wanted more for the copper. And they might have come to the conclusion that it's going to be quite difficult to to do something with Kumba without needing to buy out minorities at a big premium, which is what they want to avoid. So
Yeah.
I think looking at the details of the plan they had, they might have realized it's quite difficult to implement and still create value for BHP shareholders, rather than handing over the value to Anglo American and Kumba iron ore shareholders.
There's a very interesting question here. A view on defense companies or defense ETFs. We haven't spoken about those, I think, since the peak of the war between Israel and Hamas. Roy, is that an area that is on your radar?
Look, it's definitely interesting, and the thing about them is that they're involved in a lot of R&D. There's always some form of conflagration going on in the world, and in an ETF format, you get nicely diversified from the big R&D ones to the ones who actually produce armaments to others who are involved in other similar things. So no, it's not I don't think it's a bad idea, and over the long term, they've actually done pretty well.
Yeah. On your side, JP, I don't know if I remember correctly. I think you've chosen a defense company, Lockheed Martin or something like that before.
Yes, correct. You've got a very good memory, Zanati. So that was soon after the Russian invasion of Ukraine. And defense companies have done well on the back of that. What has been interesting is that the European ones have done even better. So Rheinmetall and Kongsberg are two ones that have gone up multiple times, much better than the US defense businesses. And I think that has to do with the fact that the US has been saying more and more, listen, Europe, you need to be spending the money. You need to be looking after your own defense. Even though we're all part of NATO, it can't come down to the US every single time to defend the whole of NATO. So I think where we are now, I wouldn't buy defense companies where we are right now. I think we might be nearing the end of that conflict. Okay. And yes, Europe will probably structurally spend more on defense going forward. But now that these share prices of the European defense companies are multiples higher, I don't think it's necessarily a great idea to buy them at this price.
All right. Well, what are you buying right now? Roy, let's get to your stock pick.
So when the world gets so complicated with all of this AI stuff and everything, I go very basic, back to Bitcorp. I think that's a stock that's sold off quite considerably. It's very ignored, but it consistently churns out earnings. And what they do is they deal in the trend in out-of-home eating. And that tends to be a big thing when economies are doing relatively well, or where culturally it's a thing that people do. So in the countries where they are present, in New Zealand, in Australia, in both East and West Europe and the UK, there is a trend for all of this growing. In addition, they're not entirely dependent purely on the top line expansion. Management's been very astute to get margin expansion from the operations just by value adding some of the commodities that they produce and that they distribute. So this is a business that banks for you 10 to 12% earnings growth. It's a complete rand hedge. There's only about 5% of earnings from SA. Very lazy balance sheet, which gives them the opportunity to do a lot of other things outside of their pure operations. Very well run. So yeah, my pick today is Bitcorp.
All right. What are you betting on today, JP?
So tonight, Zenate, it's an Italian company, Lottomatica. And Lottomatica is also relatively simple. They do betting, gambling.
Oh.
They are the biggest provider of betting, sports betting and gambling in Italy. So, I mean, South Africans have really gotten a taste for gambling the last few years. It's absolutely exploded here, whether the online casino games or the sports betting. And more or less the same in Italy. So buying into the dominant provider with the biggest market share in both these forms of gambling, I think is a reasonable idea. The shares aren't too expensive. The company was listed just over a year ago by a private equity, Apollo, and they are still selling down a bit. That has kept the share price a little bit under a dampener for the first year or so. But as they sell down, I think people are realizing that Lottomatica is a very nice business. As the free float increases, it also gets included in some indices. So the ETF start to buy the shares. And the Italians also have got a taste for sports betting and for online casino games. So that benefits Lottomatica.
And I've got a taste for pasta. Thank you very much.
There you go.
And I'll use Bidcorp's products as well. Thank you so much for your time and for your analysis today, gents. Much appreciated. That is all for tonight's Stock Watcher. Thanks to our guests, Pierre Verster from Protea Capital Management and Roy Mutooni from Sanlam Investments. Up next, The Close. Stay watching.